Welcome to this Finance University. What is it today? It is the 12th of October. Again, back here with Paul Kiker of Kiker Wealth Management. Paul, so good to be talking with you today.
Great to be talking with you again as well.
Yeah, so hey, let's start here. I think people need to know about this. A lot of stuff going on. The inflation just came in a little hotter than expected today. I want to talk about that. I'm a little disappointed again with US markets, or actually it's global markets now, where war is good for markets. Post this conflict, stocks are up, bonds are up, oil is down, like everything you would say, that doesn't make sense. But of course it does when you live in a world where the authorities feel like they have to massage every moment so that the markets don't send the wrong signal.
Yes,
Like what? That people dying is not to be cheered? Is that the wrong signal? I don't get it. It's bothered me ever since, Desert Storm 1, but it's a thing. I'm just observing it at this point in time, but it feels gross to me editorially. That's where I sit on that.
it does. And especially considering the potential risks that could spiral out of control in the region. You could easily end up in a global conflict really quickly based on what happens there in the Middle East. And the markets are just, it's like I was kind of sitting there and we've been talking about it the past couple of days, what is the basis for the market moving, right? You blow things up, you build new things. I can get that a little bit, but I think it really boils down to the fact that investors have been so trained that the Fed's going to save the day and step in and lower rates that everybody's concerned about rates being this high. They know we can't handle it from a debt level standpoint in the United States. So I think the hope, like Pavlov's dog, has been, oh, great, the war is going to cause the Fed to capitulate. They're going to turn around and drop rates a lot lower, and it's going to be markets, rising into oblivion in the future again. And of course, we've had 3 years now of a down bond market, and that lower rates could potentially help the balance sheets of banks and pension funds. And so, I don't know. There was a time in the past when the Fed would surprise the markets with the intervention. I remember, 2013 and 2010, and now it's become an expectation, and the market's trying to run this. So maybe that's it, but I don't know. I mean, I was on the investment committee yesterday, and I said, okay, great. There's mass terrorist event, murdering of innocent individuals and civilians, and the market's going to rejoice by going up. The world we live in today, unfortunately.
I know. So leaving that aside, let's turn now real quickly to I want to share this, and let me see if I can get this up, because this is actually fairly big news as far as I'm concerned. Can you see this? Are we square?
I don't see it yet.
Nope. Okay, I missed it somehow. Oh, I forgot to hit the share button. Now we're good.
There we go.
All right. So Genevieve Rock Gettr, who is CFA, who I follow on Twitter, wrote, "Good morning. I would not want to be Jerome Powell today. CPI hits 3.7% in September versus 3.6 expected. Not a big deal, right? Except that's the third straight month with inflation increasing year over year. And shelter was over 50% of the increase. Oof, right? Big deal.
Yeah.
Yeah, so the whole story, the narrative they really want to be pressing is that inflation is going down, but this is the third month in a row where it's going the wrong direction. Not a lot, but the wrong direction.
Yeah.
And so that actually has some pretty big impacts, doesn't it?
It does. It should. The market seems to ignore it at this point, but when you look at the headline inflation number higher again, and then you look at core, which core came in a little bit higher. Or in line, but now that's a 0.3% month over month, and year over year sliding down to 4.1, which was expected. Core's not been below 4% since May of 2021. So the question is, are they done at this point? Is the market correct in expecting lower rates? Because we got some pressure in. Inflation has not dissipated as they anticipated that it would.
Yeah, well, I think this is one of the big reactions right here in the 2-year Treasury note. We see here at that big red candle on the far right. That's the pop down this morning on the news. That was the first reaction. But you can see there from October 6th, that was when the attack started in Israel. And you can see there was a little bit of a pop north there, but not a lot. It went from, I'll call that 101.2 to 101.5. I mean, not a big they didn't really rally much like I expected, and that's all gone now. And so we're only like 30 basis points away at this point from, plumbing new lows on the price, but new highs on the yield. So the 2-year note is clearly saying, hey, we think there's more rate hikes coming here. That's how I read it.
It does. I read it the same way. And especially how quick the reaction was taken back from the events that took place in the Middle East. It's now all of a sudden it's back to inflation, regardless of what's concerned at higher rates, concern of inflation.
Yep. And same thing, 10-year, more of a muted thing. I mean, obviously it rallied fairly, get my little laser pointer out here, but it rallied fairly, somewhat here, but not a lot. I mean, we're basically back to where we were. It's really hasn't gone anywhere. That's not much of a rally on the fear trade. So I guess the world, you're right, the markets, the stocks and bonds and oil all just basically yawned at the most significant attack in Israel since the Yom Kippur War of 73. And with, Lindsey Graham blustering about maybe we should target Iranian refineries. I thought the markets, like you say, is that, how do we interpret this, Paul? They're just, they're just super complacent now, right?
They are absolutely complacent. I mean, you're bouncing within some ranges, but no clear breakout one way or another. Obviously, we're starting to see pressure on rates going higher, and it's quite surprising, especially with what's taking place in the Middle East. And you would think that there would be some concern over Lindsey Graham's, a restriction in the supply of oil at this point further exacerbates the inflation situation. And then you've got the fiscal backdrop there as well. So the markets are just ignoring everything at this point.
Maybe with one slight exception, and it's very slight. I don't know what to make of it yet. So these are indexes for today. Just looking at it over about a 3-day, this is an hourly. So those are hourly candles. So we got about 3 days on here, which, so we see here that the Dow Jones, adjust. I don't know what's happened since I snapped this picture. They may have all mysteriously and magically recovered. But here's this one thing: as the Russell 2000, not happy. It's the least happy here with this idea of higher rates, because that's the small cap companies. And boy, Paul, I've been hearing a lot about what's going on, like real carnage, like that corporate lending is really dried up, that they're having trouble accessing capital. Most of our zombie companies are contained in that sector. Those are the companies whose operating income can't even make the interest payments. So I'm not surprised to see that this is starting to show some real interest rate sensitivity here.
Yes.
For these guys. And editorially, again, look, DAX, Euro stocks, S&P, Dow, Nikkei, all kind of looking, I can't tell the difference anymore, but that's welcome to a broken market courtesy of the Federal Reserve. And good luck with that. So,
well, there was one difference in those charts. The Russell 2000 had that resistance at the top level. 3 times it tried to hit that. And then when it broke down on that major move, it actually broke below that prior level of support. That is different from all of those other indexes, which is representative of the debt burden that those companies are carrying, the inflationary pressures that they're carrying. And I think people are, at some point, maybe they're starting to worry about the zombie companies that are inside the Russell 2000.
Well, I would hope. I mean, that's a great point. Yeah, bumped its head up there against the 1800 level and then broke down below that. But a lot of these companies, Paul, they might have they might be facing 2 or more times higher interest costs when they roll their debt. They might be carrying debt at, I don't know, 4, and now it's going to go to 8, or something like that. That's a big deal when you were barely pulling it off beforehand. I'm surprised it hasn't been more of an issue up to now. I don't honestly know what's holding the whole thing together at this stage. I really don't.
And I've wondered about that a lot. There are times when fundamentals matter, but with the Fed intervention that's taken place since 2008, not a lot makes sense to those of us who are trying to navigate this market in a risk managed portfolio. We're polarized in the markets, as well as the half of the investors that are out there just, hey, I'm going to buy and hold. I'm going to throw it in there. I'm going to put my faith in the Federal Reserve that they're going to step in and bail us out. If they're not going to do it, we're going to get fiscal stimulus through the politicians who are going to try to protect their quote legacy or, protect the propaganda they're putting out about how great the economy is. And then you've got the other side that a lot doesn't make sense right now. Yes, we understand that there's a lag effect, but how are the markets? The markets are actually incredibly resilient. So when we get into situations like this, technical analysis, which we could relate that to an instrument rating for a pilot. Commercial pilots have to be instrument rated because there's periods of time they're going to fly in limited to no visibility. So the only thing that they can rely upon is their instruments. So that's one of the things we're having to do in managing the portfolios right now is just, I don't necessarily agree with it because at some point we're building for a major accident that I don't know that people are going to be able to sidestep. But the technicals of the market, the technical behavior of the market, if we relate that again to the instrument rated pilot, where we have no visibility and a lot doesn't make sense, are indicating that this market wants to go higher. Now, I think there's a lot being read into that because we still have major resistance. We've not broken out to new highs, but then you come into the end of the year. Even your buy and hold investors are starting to get frustrated right now, right? They're going, hey, we heard we were going to have a recession. The recession didn't take place. Our account balances are still below what they were 2 years ago. The 60-40 portfolio is still below where it was 2 years ago. And we're running into this fourth quarter, all that everybody's talking about out there. I think trying to force a self-fulfilling prophecy is the positive seasonality of the fourth quarter. So there's a lot of nervousness with investors out there that are going, hey, if we get through the end of October, like I've been talking about, since July, August, we're in that danger window and these markets continue to hold up. I think there's going to be the risk of a technical rally into the end of the year, which is going to make the average investor more complacent. But it doesn't mean that it's, it may paper over these problems in the short term, but there's still deterioration taking place under the surface. And the lag effects are going to continue building to where you have this uh-oh moment that, Wile E. Coyote, the market runs off the ledge and you see this massive drop quickly. So this is a dangerous environment still. Even if the markets go up, it's still a dangerous environment under the surface.
Well, the number one point of markets used to be to frustrate as many people as possible. That's kind of, it doesn't have to do what you expect it to do. But even still, I think you're, great points here. First, what you call positive, seasonality, I used to call the Santa Claus rally, right? It's just, that's what they called it on Wall Street, right? You rally out to the end of the year, everybody gets fat bonuses, and then, oops, the rug gets pulled in January or something. Right. I mean, that's what happened through, the 2000 season up through 2007. Same thing. I mean, I've seen it over and over again. But at this point, I think, your other major point is that this is just what we got conditioned to. And I get it. Right. The Fed was there to bail us out in 2009. They bailed us out in 2011 and 2013. And then again in 2015, 16. Then they did again in 2019. Remember 2019, like the Fed's unwinding its balance sheet, and it was like this it was like a little hiccup. Stocks were not going the right direction for a second. And the Fed dumped $400 billion in October or was it November of 2022 in like a week?
Yes.
400 billion into the markets just so that they wouldn't go down or send the wrong signals or something like that. So I think it's fair for people to expect they'll just keep doing that. I mean, is there an alternative?
Well, the alternative, I believe, years ago, the alternative would have been to just let the markets be free and burn out, let the recession come and burn out the dead wood, get rid of the zombie companies. We could have done that without systemic risk 7 years ago. I think we could have done that without systemic risk in 2019 before we got into COVID. The problem is where we are right now. If we let that take place, you've got an unbelievable number of companies that have, to try to compete. So one of the things that lower interest rates do is allows more competition into the marketplace, which drives down revenues. So, and then there's always a solid company that's competing the right way. And then there's others trying to come in that are gambling, really. They're carrying too much debt. They're trying to to get their share of the market, they're driving margins down. So you've got all of these companies out there that have gotten into a situation where they've had to carry more debt because their profitability has been driven down because low interest rates have made credit easier, which has increased competition. So now you run a situation where you literally potentially run into a Great Depression if they do just let the system correct itself. So if they're smart about it, they're trying to do it in a managed, destructive way so that we can get back to a more solid fundamental basis, foundation economically. So I don't know how they get out of the situation that they're in, because it's either massive deflation on one side and massive unemployment, or they print, and we have massive inflation, which inflation is just absolutely devastating. I'm far more terrified of inflation than I am deflation.
Well, let's look at all the pressures right now. So this is why I can't believe the complacency. But again, with whatever it is, 90% of the activity on the stock market, contained by just a few high frequency firms. I think Citadel alone's like 25% of all the trading volume. So it's just one firm controls a lot of the action, right? And then we have this crazy thing now where you've got all these leveraged things. Like we pay attention to the cash market, and that's what I just showed. I showed futures showing, what's going to happen in the cash market. But honestly, the options market, really, really drives this thing. I mean, there can be days when the fundamentals scream that the opposite should be happening, but you get the opposite of that, right? Because, there's just so much leveraged options, these 0-day, trading, options, the zero DTEs, that you've got, just all the puts and calls, on and on and on, blah, blah, blah. For people who don't know what we're talking about derivative bets. These are bets upon something else, and the underlying is the something else, but the bets are actually sometimes many times larger than the thing itself.
Yes,
that's being bet on,
Well, and one of the technical underlying events taking place in the market right now is the fact that CTAs, which are basically hedge funds that manage futures on a technical basis, right?
Mm-hmm.
So they're extremely short the market right now. They were extremely short the market a couple of days ago. And what that does is basically force, because they're doing it through the options market, is force these dealers to buy to manage their risk. So it's forcing buyers in the market. And yeah, you've got all kinds of problems that are taking place, all kinds of potential issues under the market. But when these CTAs or managed future strategies have to start covering those shorts, I mean, I think one statement from Charlie McElliott at Nomura was saying that there's $283 billion that'll potentially be buying the market on an uptake, up market, if we continue that over the next week or so. So you look at that, I mean, that's technical buying. These are computer strategies. Most of them are managed, regardless of what the individuals think is going to happen. And that can provide fuel, maybe one last gasp in this market to give that positive seasonality into year end before the major pain comes in the spring. Now, that's not a prediction of what's going to happen, but it's one of the things when we're managing money and working with individual clients, that expectation management that you have to pay attention.
Mm-hmm.
You don't want to be surprised dramatically from that, especially if you're an investor that's taking a short position in the market right now, which is I'm not recommending by any means whatsoever. You have to pay attention to that, or you can lose a lot of money very quickly.
Yeah, well, let's look at I mean, those are great points. So there's all this. Listen, this is what happens after 20 years of just the Fed just flooding the markets with liquidity. It has to go out and find things to do, and if there's tons of liquidity, it finds all kinds of clever things to do. All right. These, By the way, I'm of the opinion, Paul, that they could have one of those fabled neutron bombs, right, go off, and it kills all living things, right? But if the computers are still on, they'll still be trading. Like, this would make a great little sci-fi movie. All the humans are dead, and the computers are busy deciding that GM is a little over leveraged right now, and the options have to be closed out. So the stock price of GM is still trading along merrily, because that's what the computers do. They run on some other. They just do what they do. I mean, we don't have like this whole idea. Like, I hate this when they're like, Market Watch is like, oh, traders reacted to, and they show a picture of actual guys in jackets staring at computer screens, on the trading floor. I'm like, nah, there's none of that doesn't happen anymore. They should show a rack of server lights, That's
Yeah,
that's
that's
their whole
right.
thing now.
That's what they need to show in there for sure. Well, another interesting statistic that came out today. So, according to the Wall Street Journal, 80% of American households by income, bank deposit, and other liquid assets were lower in June of this year than they were in March of 2020 once adjusted for inflation. So, one of the biggest concerns that I have is you've got investors that are complacent.
Hmm.
Let's say that's 20% of the population, okay? The other 80% of the population is also complacent because they're borrowing themselves into oblivion. They're utilizing, credit card debt levels are continuing to increase at the highest level of credit card debt that we've ever had. And, and there's some other data I can't remember who came out with. We have the highest interest cost burden on households that we've ever seen throughout history. But consumer spending and discretionary spending is still continuing to go along just fine at this point. It's holding up very resilient. So I think there's a lot of complacency by the 80% of the population that doesn't manage their finances as good as they should. And their expectation is, oh, don't worry about it. They'll postpone our student loans again, or the government will bail us out, or they'll drive interest rates to zero and we'll be just fine, with this
Hmm.
expectation that the government can continue to do this. And at some point, we're going to hit the wall. Who knows whether they kick this can down the road another year or 2 years. I think there's a lot of incentive by this administration and those that are supporting this administration to try to keep these markets up into the 2024 election, so they can claim, hey, we've done this. But if they are successful in kicking the can down the road that far, then the other side of that may be a completely different story.
Well, sure, we're just building more and more potential energy. We haven't had the decent recession, but you know what? I put this out recently that Jay Powell, chairman of the Federal Reserve, he's aged like a decade in the last couple of years, right? Like he's really carrying some pressure on this, and he's dead serious about this. He's I take him at his word now, which is rare because I haven't taken a Federal Reserve chair at their word in 20, 30 years. I think he's going to keep raising rates and hold them there till something breaks. And the longer this doesn't break, if I'm following you, the idea is that, well, then maybe that leads to a worse break. Like a lot of potential energy in that system. It holds, it holds, it holds, and then it really snaps.
Yes, yes. That's my concern. And that's what it looks like at this point, especially with the market's expectation. Let's just assume, and this is assumptions at this point, that when all these horrific events took place in Israel, the market rallied on that. Okay. So, like Pavlov's dog, the market's going, oh, we're going to cut rates sooner rather than later. And I've seen all kinds of headlines across Twitter and other places. Oh, rates are going to be much lower in the next 3 to 4 months than what anybody's anticipating. The Fed's way ahead of the curve. They're making a big issue. But then we had these sticky inflation numbers come out today. So, yeah, those can change. Now, as a side fact, one of the interesting notes was auto coverage or motor vehicle insurance went up 18.9%.
Mm-hmm.
Yeah. So that does potentially lead to a breaking of the system. And I do as well take him at his word, because if you listen to what he's saying, not what people are speculating that he's going to do, he's saying that he's going to hold rates higher for longer. And yeah, they're pausing here because they understand that there's a lag effect in place. But I think, on one hand, they're coming out saying there will be another rate increase sooner rather than later. And then Janet Yellen comes out and says that's not going to be the case. So, but if you listen to what Jerome Powell's saying in the chair, he is saying that he's going to stay higher for longer.
Well, and this is creating, issues all around the world. One of the big ones I know we've talked about before, but Japan's in the news. They're working. First off, they're selling treasuries because they're trying to defend their yen at about the 150 to the dollar mark. Good luck with that. It's proving to be very, very expensive. But they were just in the news. I'm sure you probably saw it, but this past weekend, the same weekend that Israel got attacked, they had upgraded their whole bank server software system. And as recently as yesterday, they weren't able to clear transactions. Like the whole system was like glitchy and failing to clear. So when you
Oh,
have a giant banking system that can't clear transactions, it's a big deal. And so that was all over the news the last few days.
that's a big deal. And I don't know how I missed that, but I did miss that in the news. So
Oh, they kept it nice and quiet, but you got to you got to go to those corners of Twitter, which, anyway, it came up on my screen and I chased it down. It is true that it very glitchy and they didn't know what they were going to do. Like, were they going to have to like roll all the software back, or it was a big deal. But those glitches are kind of things, Paul, that I'm used to seeing at what we call market tops, where you get those weird little, like, is that a real print? Where all of a sudden like a treasury will like bust at like a huge move one way or the other, and then they fix it, But you watch those glitches roll out, and those are my unofficial warning sign that you're approaching that, a transition point.
There's a lot of warning signs that are taking place right now. We've had the Mexican peso that has rallied dramatically against the dollar. That's been one of the most popular carry trades that have been out there. You've got Japanese that are having to sell treasuries going into one of the largest issuances that we've seen between now and the end of the year, which is, can potentially put pressure on rates being higher. My big question is the bond managers. I think, what is it you said? What's your statement about bond versus stock managers? I can't remember, but the bond managers are they're smartest people in the room because their margin of profit is so much smaller than what it is on equity investors. Yeah. So, we start seeing the 10-year really break out. We're starting to see the 20-year yields go higher. What I mean is when we talk about breaking out and going higher, are the bond investors starting to say now, we don't have any confidence in the American political backdrop that they're not going to be so fiscally irresponsible that we end up in a major problem. And so there's no definitive proof that that's what the bond market's saying right now, but you've got these, higher rates that continue to indicate that that's the case. And especially, when the Fed's making the comment, well, the 10-year is kind of doing our job for us right now because it's jumping dramatically. And I think 30-year mortgage rates are over 8% right now. So that's an indication. You can look at it one of two ways. I read one individual that made the comment, well, that's banks understanding that rates are going to be slammed back down to zero again. So they're trying to get 8%, 8.25%, 8.5% as quickly as they can right now so that they can build in some extra, profit before rates go lower. I don't necessarily believe that that's the case, because if you believe that interest rates are going to go a lot lower and you're competing against someone else, well, I'm going to do 7.5%. I'm going to garner all of that business, because if I think rates are going to go to 4%, well, 7.5% is still great. I don't need to be pushing for 8%. So my concern is that it's either a risk. The banks are seeing a major risk in real estate prices, correcting somewhat, maybe not a 2008 type crisis, but if we drop back to 2019, that's 30% below where we are right now, or they're extremely concerned about the long-term foolish fiscal decisions that our politicians seem to be willing to undertake for short-term benefit. And they're recognizing that we need to be compensated higher because higher inflation for longer is a major concern.
Well, it is. And, of all the warning signs, obviously we got like student loan repayments fire up now, basically this month. As you mentioned, the consumer's pretty well tapped out. There's a variety of things going on, but here's something I wanted to get your view on, because to me, there's a variety of things that really make my eyebrows shoot up, and this is one of them. So demand for corporate loans. So this is pretty clear sign here, right? So anytime that this is the zero mark here. So corporate loans are, advancing 20, 30, 40, 50% in this environment. But here they are coming down in 2000 and 2001, coming down to like minus 40, 50, 60%. When they come and cross the zero mark, recession. When they come and cross the zero mark, recession, right? So here's 2020, right? Which, again, we had this little glitch in 2019, which, I'm very suspicious of how the Fed behaved there and how much money they dumped in the market. So they got this little burst here after dumping 400 billion in, but, came down. But this was all polluted then by all of that, covered up with all of the COVID printing. So again, came up, but kind of a weak bounce, historically speaking. And now look at this. You got to go all the way back to 2008 to find demand for corporate loans at such a depressed level.
Yes. And the trend was, you can see in that chart clearly that since around 2013, 14, the trend was down overall, but it had stabilized around that zero level from 2015 through 2017 and started to work its way down outside of that burst of COVID. So, I mean, that's, demand for corporate loans. That tells you businesses are not expanding. They're not reinvesting. They may be reinvesting, but they're not aggressively investing into future business capabilities. So that is recessionary. So, the question is, are they focusing on financialization and recharacterization within inside the books more so than trying to expand their business models going forward? So that's another indication that the markets are absolutely ignoring what's taking place under the surface. And the only thing that I can come back to is they have, like Pavlov's dog, this belief that the Fed's going to juice everything again, that they're just going to bail us out and, hey, 2020 worked. They're just going to print money and give it to everybody. I don't think we can continue to do that. We should not continue to do that morally or ethically. But I think that's what the market.
What's the argument? So first, two arguments that I need to explore. Maybe we could steelman this. One is Timothy Geithner, popularized this idea that there's systemically important banks, SIBs, and that there's something would happen. So when we say there's a systemic risk, this is what they're so afraid of. Oh my gosh, this could be a systemic risk. What does that actually mean? Do we know? What would happen if a systemic risk got realized? What's the fear, do you think?
So
I've never heard it spelled out.
That's a good question. And I was trying to think, have they ever actually explained what that would be? So from my perspective, a systemic risk would be a catastrophic collapse of the banking system. So in other words, you have and I think it may roll over into the derivatives industry, quite frankly, which is that monster guillotine that's hanging over our entire system if that was to come apart. Let's say JP Morgan, Bank of America collapses. Then you could have a shutdown in the banking system where you don't have enough FDIC deposits on hand to cover what, and I can't remember specifically what that is, but they've got pennies on the dollar compared to what the implied guarantee is. So that not only would you see the banking system collapse and mass layoffs, but you would also see the government having to step up and carry that implied backing of the FDIC institution. So a systemic collapse, in my opinion, would be akin to the Great Depression, because that's kind of what they talk about. We didn't print enough money to stave off the Great Depression, so we have to do that now. So that's my thought. What do you think, Chris?
I don't know. I think I bet you it hasn't been really well articulated. It's just sort of this cartoonish, it ends up in Mad Max. Like something happens, JP Morgan goes down, and next thing you know, there's people eating each other, cannibalism in the streets. I don't know what they think, because I'm this guy back in 2009. I was kind of cheering. I'm like, hey, if Citibank goes down, it goes down. You know what? The bondholders ought to get wiped out. Caveat emptor. Do not, loan money or put your faith in a company that's that poorly run in the future. It'd be a little painful for sure. There'd be a bunch of losses, but then guess what? Better businesses would fill that vacuum very quickly, better run businesses. So I actually think a little creative destruction is a good thing. Like I think capitalism really needs competition. I think it's a good thing, but they seem to think it's a bad thing. And I don't understand it. And their argument seems to be, well, you're kind of right, but that was so 20 years ago. We kind of let things get out of control to the point that where we can't risk that sort of creative destruction anymore because it would be too catastrophic. But I hear this argument and I always stump people when they say, oh, but think what would have happened if the Fed hadn't intervened in 2009. And I ask, what?
Yeah.
And they're stumped, That's just, they bought into the narrative that there's too big to fail. But isn't it convenient that too big to fail means that the biggest of the big get to run serious risks, reap the profits from that as long as it doesn't blow up, and when it blows up, they get bailed out? I mean, isn't this just the oldest bailout story in the book, just with a new shiny wrapper of systemically important wrapped around it? That's how it feels to me. But maybe I'm missing something. Maybe it would be Mad Max. I don't know though.
Well, they've not articulated well that it would be. They've just put it out there, and that, systemic risk is something that gives every individual a different picture of what that may end up being. But I agree with you. So let's consider if they let those banks collapse at this point. So we had a 60 to 75% drop in the market. You're going to have high unemployment. You're going to have the bankruptcy process that we would go through inside the United States. And these predatory lenders who are lending to the bottom 50% of the American populace and keeping them down because they're capitalizing on their lack of financial management, they're going to collapse. And guess what? They're out of the market. They're out of the market. If you backstop the FDIC system, that's less money in the system, and I bet you're not going to have BlackRock and all these other institutions coming into communities and buying 168 houses, which are pricing out your average individual. So you'd have home prices come down. You would have salaries come down as well, but it would hit that reset button back to where you have the average individual takes a larger share of the wealth in the country. So if you go back prior to 1929, and I cannot remember these numbers, so for you viewers out there, I'm butchering this, I'm sure, but it's going to be pretty close. Close is relative. So I think it was something in 1929, 90% of the assets were owned by the top 10%. So not exact, but it gives you an idea. By 1933, 1934, because those too big to fail institutions lost their control of cornering that market and their monopolies, you had 90% of the wealth owned by 50% of the population, something like that. So that led to the 1940s and 1950s and 60s, where you had a thriving middle class. So in my opinion, if you really look back historically, the worst outcome on the other side of the pain that we would endure would be a thriving middle class if we let these too big to fail institutions collapse. The problem is our politicians have a vested interest, because guess what? Their funding comes from these too big to fail institutions. So their careers and their grip on power is going to be gone, because the average individual is going to push them out and probably talk those individuals who have no desire to get into politics to step up to the plate, because we need good leaders to get in control. So, yeah, I think we would be a lot better on the other side. Now, there would be tremendous amounts of pain in the short run, but here's the good thing about the United States. You don't go to jail for filing bankruptcy. There are other countries that if you can't pay your debts, you go to jail before you pay your debts. So our system does allow that burden to be removed from the individual in poor economic times. So as bad as it would be, it'd be nice if we could do it in a little bit of a controlled, destructive way. But that systemic collapse may just be the best thing that happened to the average American citizen.
Well, so let's talk about the system for a second, because here's the second thing that bothers me, and this is just dead obvious. I don't have the chart with me right now, but I show it all the time. So hopefully people know what I'm talking about. It's a chart with just two lines on it. One is GDP of the United States. It's a line that goes like this. And then the second is total credit market debt, not unfunded liabilities, underfunded stuff, not Medicare, Medicaid, none of that, just debt. So that's corporate, state, household, federal, debt. That's a second line, and it goes like this, right? And those two are growing apart. And so that's the system. They're saying, oh, we have to preserve that system, because otherwise this would be a systemic problem if we let that begin to correct. But we have a math problem, Paul. You just can't have your debts constantly compounding at twice the rate of your income. But that's the system that they're busy defending. And I just look at that and I go, this is going to hurt, but this is one of those rip the Band-Aid off moments, because the longer we wait, my position is, the worse that's going to be, to the point where it might just, if you finally wait too long and it breaks of its own accord at some awkward time in the future, that could be sort of a lights out sort of a moment. That's what I worry about. And then of course they'll probably ride in. That will be their reason for having a central bank digital currency. Good news, bad news. Bad news, JP Morgan just folded. Good news, we secretly created a separate account for you. All your money is now over here in the Fed. JP Morgan went out of business, but your money is still, alive and well, I guess. I don't know. But
well, I would assume that they're going to take advantage of that opportunity when that day does come, because one thing that another way to phrase those two charts is it takes ever increasing amounts of debt for smaller and smaller increases in GDP. So have we reached the point now that we have ever increasing amount of debt just to maintain GDP? So, but But the bingo point is once that chaos unveils and the pain hits the American people for a short period of time, oh, here's the central bank digital currency. And then my concern is we move into full modern monetary theory where they're like, oh, we'll give you a monthly income. And if you don't spend that income in 90 days, it goes away. Now that does allow them to continue to keep their hands on the reins of power in a much greater way, because now we have no anonymity in our transactions that are out there. The government knows everything, and in real time they can track exactly what consumers are spending. And in a corrupt system, those that are closer to the data source are going to be able to front run the investment news before they come out, and further embolden the top 0.5%.
Well, and this is, of course, very frightening to a lot of us because I just got a call from Dane, who works with Peak Prosperity, a couple weeks ago, and he said, "Hey, went down to my local coin shop where he buys some silver bullion from time to time, and the guy said, hey, we're kind of out of commission for now because we just got debanked. Just got a letter. A bank they've been working with for decades said you no longer have an account here. You have 30 days to move it, and you can't do anything in the meantime." So that's happening all the way at the coin shop level. We saw truckers and the truck movement in Canada. We saw people who just donated $25 to that because they believed in the right of people to have their voices heard in an allegedly free society, get debanked, have their assets frozen. There's been a fairly significant push for that. In just this week, in the context of the Israeli war and conflict and all that horrible stuff that's going on, I've seen people openly saying that people who express the wrong opinion about that ought to suffer the consequences for that. So we've got this really weird vibe now where people want to commingle your point of view with whether or not you ought to be debanked in a society where, Paul, I gotta to me, that's as violent as anything you could do to somebody. If you said fundamentally, if the system came along and said, Paul, we really don't like your position on fly fishing. We've decided it's the worst thing ever. And you no longer can bank with any banks. Well, that's kind of a game over moment. I mean, it's very serious. I don't think we're treating this as seriously as it actually is at this point. All things considered, because you can't operate in this world of electronic, everything without having access to that system. It's bizarre to me that too complacent about this.
That is absolutely terrifying. That is terrifying because and I can't think of the name of the individuals. Who was it? Nigel Farage. Is that who that was? Issue that he had that was debanked, but he was a public enough figure that he could bring it to the attention. But now you've got a small business that deals in precious metals that was debanked. To me, that is one of the most terrifying situations that can take place, because in a credit-based system, you can't go borrow enough money to most businesses are going to have to borrow money to undertake a business venture, because there's just not enough profit in the system right now for people to accumulate, with inflation eroding purchasing power, to go pay cash to start a business unless they're heir to a trust fund or something of that nature. So it effectively cuts you completely out of the system. You're not going to be earning any interest where you are. A lot of places aren't taking cash anymore. More and more places aren't taking cash. So, and how can the government allow that to happen to an American citizen and an American business when they're propping up these institutions because they're too big to fail? That doesn't make sense to me in any way whatsoever, because the government is supposed to protect our freedom and protect that system. They should immediately decharter any bank that's willing to debank an individual, unless it goes through a court of law and they're charged with fraud or some criminal activity, and then the business goes away, so they're effectively debanked. That's insane.
It is. It really is. Well, I've got to move on because I've got another podcast coming up shortly here. So, Paul, again, for everybody listening, this is Paul Kiker of Kiker Wealth Management, Peak Financial Investing's endorsed financial advisor. Paul, every time I hear from somebody who started to work with you, I just get nothing but glowing reviews. That is just the number one thing I want to hear. You just do a wonderful job helping people feel heard, helping them really think through their financial situation, taking a really calm, risk-balanced approach with a lot of experience. So thank you for doing that, because it feels really good to me to be able to send people to somebody who's got that experience and well, those people skills.
Well, thank you, Chris. It's our honor. I have thoroughly enjoyed talking to individuals, helping them develop a plan, prepare for the future. We don't know what's going to happen, but we do have the ability to adapt and put plans in place so that if we cross certain lines, this is the decision that we need to make now. And that's provided a lot of comfort to the individuals that we talk to. And I've thoroughly enjoyed it. To be able to have the opportunity to help people in this period of time and to help point them in the right direction and help them to ask the questions that they don't even know to ask so that they're better prepared. And it's all about making sure that each person that we talk to is mentally prepared, understands what's taking place, has a plan in place so that they're ideally, no guarantee, but ideally 2 steps ahead of the average individual when we need to make that turn so that they don't go off the cliff with the herd, with just basic trust in institutions that are increasingly being deceitful in the information they're putting out. So it's our honor, Chris. It is.
Well, thank you. So for anybody who wants to go and maybe, listen to have a free consultation with Paul, no obligation, talk to him about your situation, go to peakfinancialinvesting.com, and very simple form. Somebody will contact you, and it's a very simple process. So with that, Paul, thanks so much for this. We'll see you next week. Hopefully it's a nice calm week and things sort of hang together. That's what I hope.
Good to see you, Chris. Always an honor.
Likewise. All right. Next time. Until then, bye-bye.